Hello and welcome to Module 5 of the Sanfin training. In this module, we will interpret the results of a risk analysis. The results of the risk analysis will indicate whether the client has sufficient provisions to provide for their financial goals and needs. As you will recall, the risk planning process involves determining the capital needed to fund financial goals and takes into account the existing provision. The purpose of this module is to explain the results of the risk planning analysis. By the end of this module, you will be able to demonstrate understanding of the various risk planning charts and be able to interpret the results of the analysis. We continue to follow the 6 steps of financial planning. In order to present and recommend a solution, you must understand the reports. You generate the reports in the client focus area. In order to gain better understanding of the risks identified, the client's capital and income needs. Information in the different charts are displayed in a visual format or with visuals and data. Note that the charts cannot be amended. Amendments to information used in the financial analysis must be done either in the client menu or in the risk F&A. Different charts display different information, but all reflect aspects of the results of the risk analysis. Charts will be available for the client and the partner depending on the event selected in the economic data section. The following charts are available in the risk F&A: client proposed cover, client needs, client summary, and client sensitivity. The client proposed cover chart displays the results of the risk planning analysis as a bar graph with no values. The planning event selected will display the relevant bar graphs. Information displayed is as follows: capital requirements, which is the client's lump sum needs. Capital required to solve cash flow shortfall. This is the cover needed to fund income and lump sum objectives. Capital provisions, which is the client's existing provisions. And additional cover required, which is the risk cover needed to fund capital and income needs. Capital requirements represents the lump sum needs of the client and relates to capital amounts required at the chosen planning events. These amounts must be provided for as part of the risk plan. Examples of the capital requirements are liabilities to clear, upfront capital expenditure, total estate expenses, accrual payable, and other needs. Capital required to solve cash flow shortfall represents the total amount of cover needed by the client to fund the income and lump sum objectives. It includes the following: future objectives, future expenses, future education, tax on income, and cover required for tax and interim cash flow liabilities. Capital provisions are existing provisions of the clients taken into account in the risk plan. It consists of the following: disposable assets, retirement fund lump sums, and existing cover. Additional cover required is the risk benefit amount to be implemented. This is to provide for the client's capital and income needs and objectives. The additional capital required is the difference between the capital position and the cash flow position. Capital position consists of the provisions less requirements, whereas cash flow position is income less expenditure. The client's need graph indicates the cash flow over the planning term. It takes into account all available cash to be used for the risk plan as well as expenditure required over the risk planning term. The client needs, on the other hand, are characterized as capital, which is current, which is the surplus or shortfall applicable to any capital needs the client may have. Remember, capital needs are lump sums that are due at death. Capital proposed is the capital amount needed to solve any cash flow shortfalls. An expenditure is any living or medical expenses that the client would like to provide for over the planning term. The client summary report provides detailed results of the different selected planning events. The information is presented in 3 categories: expenditure and requirements, income and provisions, and additional cover required. The cash flow position, which is the discounted cash flow, takes the client's income provisions and needs to determine an income shortfall or surplus. The income amounts are capitalized in order to determine a shortfall or surplus. The additional cover required is the difference between capital and income amounts. Cover sensitivity illustrates the effect of implementing a reduced cover shortfall. It also indicates how it will affect the capital required. The client cash flow position compares the sustainable monthly objective and the averaged monthly objective. The result is expressed as a monthly excess or shortfall. Sustainable monthly objective is the maximum monthly objective, escalating at CPI, which can be sustained over the projection period. This includes existing contributions and liability repayments. Averaged monthly objective is the monthly expenditure, excluding existing contributions and liability repayments, averaged over the projection period of the cash flow. It includes CPI escalation annually. It is important to note that these charts are downloadable. It could be included as part of the client feedback discussion during the follow-up meeting. Please remember to complete the assessment for this module. The assessment can be found on the learning portal following this video.